Chapter 14, Cost of Capital. Chapters 12 and 13 that we've just finished were on the rate of return on an investment. In particular, we talked about stocks primarily, as well as some bond investments. This was all sort of part of this block of 3 chapters, 12, 13, and 14, which look at basically the discount rate, as I'm going to explain shortly. Okay, on this slide I summarize the chapter outline. Let's move on. 2 things you will learn in chapter 14. You will learn what we mean by a firm's cost of capital, which includes the cost of raising equity or money through issuing common stock shares, cost of raising debt. There's also cost of raising a different type of stock called preferred stock, and sort of a combination of all 3, equity, preferred stock, and debt, which we call just capital, so overall cost of raising capital. And then you'll learn about pitfalls of overall cost of capital and how to manage them. Okay, let's look at the big picture of what chapter 14 is all about. It's actually pretty simple. Let's start with something you already know well from our earlier chapters. Question: How do firms make new investment decisions? The answer is, in chapter 9 we looked at 4 very different ways to evaluate an investment opportunity, and sort of the winner was the net present value criteria. A project or an investment should be accepted if its net present value, NPV, is greater than 0. Otherwise, the project should be rejected. How do we find the net present value? The net present value formula says we take spending in year 0, which is a negative cash flow, and add the present value of all future cash flows coming from this investment. Let's kind of expand it a little bit. Spending in year 0 with a negative sign because it's a cash outflow, plus what's the present value of all future cash flows? It's cash flow in year 1 discounted, or mathematically divided by 1 plus the discount rate. Then we add cash flow in year 2 divided by 1 plus the discount rate squared, and so on. We keep adding additional discounted future cash flows estimated for this project. The focus of this chapter is the discount rate. Up until now, it has been given to us. So the required return on similar investments is 10%, for example. We will no longer, use some given number in our net present value problems. So what should the firm use for the discount rate when it's trying to find out whether a new investment is worth it or not worth it? This is what these chapters focus in, the discount rate. So how do firms figure out what discount rate to use? Once again, a common sort of problem in finance, or at least that's what a lot of students always complain about, is the same thing can have so many different names. Well, it's coming up again. Discount rate can also be called a typical return for investments similar to this one, or a required return on an investment. We saw a whole bunch of other terms, like when we talk about bonds, we say yield to maturity. Then we can also say interest rate, rate of return, growth rate, right? APR, which stands for annual percentage rate, and so on. In this chapter, we will also use a couple of additional terms: cost of capital and weighted average cost of capital. So these 2 terms will be new in this chapter. Okay, so let's say a firm wants to, invest into a new investment project. There's a lot of money required for that, which we typically call net capital spending, right? It could also be some increase in net working capital, like we saw in chapter 10 in this class. So we might be talking about hundreds millions of dollars that need to be spent. Do firms in real life have this kind of cash lying around? Usually they don't. So they need to raise money for new investments. And firms often do so from two very different sources. Maybe just one of them or maybe both. One, they sell new shares of stock. So that's the equity source. Two, they can borrow more money. And large corporations that need to borrow a lot of money, the easiest way to do so is issue a whole bunch of new corporate bonds. So each bond is like a mini loan that brings money to the firm. Okay, so there are investors that buy our firm's bonds. So they provide money to the firm in exchange for corporate bonds. Then there are other investors, stockholders, who buy firm's stock shares. So that's another source of money for the firm. The firm issues shares of stock, investors buy them. In return, the investors pay money to the firm. Okay, so is getting money from bondholders and stockholders free to the firm? Of course not. Nothing is free in this world. There's no free lunch, like we say in finance. It costs the firm money. We say there is a cost of raising debt and there is a cost of raising stock. So it's like a dollar amount that goes back from the firm to each of these two groups of investors. And now when we know what the cost to the firm is of using this money that bondholders and stockholders provided when they bought the firm's bonds and stock shares, we can then say that, okay, since the firm is now responsible for making these payments back to bondholders and stockholders, by the way, what are those payments? It's basically coupon payments on bonds, face value in bonds, dividends on stocks, those kind of things. Because the firm is now required to make all these payments every year back to bondholders and stockholders, it needs to be able to raise enough money every year from all of its investment projects that would be high enough for these required payments, high enough to cover the cost of raising debt and the cost of raising stock. So the required return on any new investment is some sort of average, or we say weighted average, cost of capital. So it's like some sort of average of the cost of debt and the cost of stock. Let me give you an example. Let's say bondholders pay $100 to the firm to buy the firm's bonds. In return, every year, the firm needs to pay back 4% of that, the money that came in, right? So it needs to pay coupon payments, those kind of things. Similarly, for stocks, when investors pay money to buy the firm's shares of stock, the firm is now required to pay back, let's say, 6% of that amount every single year. So every year, the firm needs to pay 4% back to the bondholders who bought the firm's bonds, or like 4% of the amount that the bondholders provided to the firm, that the firm raised from bondholders. And every single year, the firm needs to pay, let's say, 6% of the money that it raised from stockholders by selling new shares of stock to the stockholders. The average of 4% and 6% is 5% if we assume that equal amounts of money came to the firm from these two groups of investors. So 5% is the simple average of 4% and 6%. And what we can now say is that 5% is the bare minimum that this firm needs to earn every year from new investment projects on the money that it invests at the beginning of the project. So this is the required annual return on the money invested into any new investment project. I have pretty much explained, everything in chapter 14. And now we'll just look at some, technical details. So we're going to review what we mean by cost of debt. And by the way, it will be literally a review of something we saw in chapter 7 on bonds. Then we're going to review formulas that are relevant to calculating the cost of raising stock. That will be chapters 8 and 13. And then we're going to put the formulas together. Okay, so that's the plan. So to summarize, a firm needs to earn at least the required return to compensate its investors, stockholders and bondholders, for the financing that they have provided to the firm. And so the required return on any investment project is the weighted average cost of capital. So it's like the average of the cost of debt and the cost of stocks. It's also the same thing as the proper discount rate needed to calculate the net present value of a new investment project. Okay, in other words, the weighted average cost of capital, so we are now kind of starting to derive this sort of average of the cost of stock and the cost of debt. And we're going to be calling it weighted average cost of capital. So the weighted average cost of capital is some sort of combination of cost of stock and cost of debt, some sort of average of the two. So I'm not putting any mathematical signs like plus or minus here. I'm putting the and sign. We're going to get to the exact formula over the next slides. First, let's expand it a little bit. Cost of stock. Is there just one type of stock that a firm can sell? No. From one of our earlier chapters, which was chapter 8, in which we looked at stocks, you may remember that there are two types of stock. One called common stock or equity, and the other one is called preferred stock, which has preference over common stock shares in paying dividends to the investors. So the weighted average cost of capital is a combination, or more like the average, of these three things: cost of equity or common stock, cost of preferred stock, and cost of debt. These are the notations that this chapter will be using. It's all R's because everything is returns, percentages. Weighted average cost of capital will be denoted by WACC or R subscript WACC. The cost of equity will be denoted by capital R subscript capital E, or E and then in the brackets R subscript E. Cost of preferred stock R subscript P, and cost of debt R subscript D. Let me rephrase the idea behind the weighted average cost of capital. Essentially, for the first time in this class, we are looking at things like dividends that the investors receive who are buying shares of stock, or coupon payments that the investors who are buying bonds receive. We are looking at those from the point of view of the firm, rather than from the point of view of the investors. So, from the firm's point of view, the cost of capital is the price that the firm has to pay to stockholders and bondholders for raising money from them for its investment projects. So the firm needs to pay dividends, the firm needs to pay coupon payments on bonds, right? If the firm raises money by issuing stocks and bonds, then its cost of raised capital is the expected rate of return that needs to be offered, that the firm needs to offer to its stockholders, as well as the rate of interest that it needs to pay to its bondholders. So everything is from the firm's point of view in this chapter, how much the firm pays, which is the same exact amount of money as what the investors receive, or the return to the investors. So from investors' perspective, the weighted average cost of capital is the return that these investors, stockholders and bondholders, require that the firm makes on its investments projects, that would be just high enough to cover the necessary payments to them, to stockholders and bondholders. Okay, let's start by looking at the cost of equity. I have 18 slides. It looks like a lot. Trust me, there won't be anything new on the next 18 slides. It's really a review. About a third of this chapter is a review. But everything that comes together in this chapter comes from, let's see how many chapters, 8, 7, and 13, from 3 different chapters from before. So it's worth reviewing everything and kind of putting things in its place. So cost of equity. So that's basically the link between the firm that raises money from those type of investors who buy the firm's equity, or common stock, in other words. These are 2 terms used interchangeably. And there are other investors who buy stock shares, but they're buying what we call preferred stock shares. So that's going to be on later slides. So let's focus on equity or common stock, or more precisely, cost of equity from the firm's perspective. From chapter 2, equity means if the firm were to sell all of its assets and use the sale proceeds to pay off all of its debts, liabilities, then equity would be the residual that would remain, and that would belong to the owners of the firm, or the shareholders. Equity is also part of firm value that's traded in the market in the form of stock shares. Equity is also the bottom right of a balance sheet. So what is cost of equity? It's the return required by equity investors given the risk of the cash flows from the firm. We actually had 2 formulas already, 2 different approaches that were calculating the cost of equity, except we were never calling it cost of equity. We were calling it the return to stockholders, for example, or the required return. The first approach is from chapter 8, the so-called dividend growth model approach, which looked at how the price per share of stock is calculated when the dividends in the future are assumed to be growing indefinitely at a very specific and constant growth rate every year. The second approach, we're going to call it the SML, which from chapter 13 stands for the security market line approach. Or alternatively, we can call it the CAPM, capital asset pricing model approach. So that was all in chapter 13. Let's start with approach number 1, the dividend growth model approach. Let's review it. To use this approach to calculate the cost of equity, we need to be given 3 things about the common stock shares. The current stock price, so price per share today, the current dividend, or the dividend that will be paid next time, and the dividend growth rate. This is all from chapter 8. We are just reviewing it. So let's review it on using this timeline. Let's say company has just paid some dividend per share. Maybe it's $2 per share. The notation for the current dividend is D for dividend and subscript 0 for year 0. In 1 year, it's going to be a higher amount. It will grow by some percentage, which we denote by lowercase g. So the dividend in 1 year, D subscript 1, will equal D0, the current dividend, multiplied by 1 plus G, the growth rate. In 2 years, it will be even higher, and so in the formula, you will add the power 2 to the term 1 plus G. Year 3 from today, the dividend will be higher again, the power changes to 3, and so on in perpetuity. How do we find the stock price today, which we denote by P, capital P, subscript 0, price year 0? It's basically a perpetuity, present value, but it's not just a so-called level, flat perpetuity, it's a growing perpetuity. This was covered in chapter 6 in this class. See how many chapters we are reviewing in chapter 14? So the growing perpetuity present value formula says take the cash flow, the very first one in the future, so a year from now. In our case, that's the dividend in 1 year, D1, and divided by R minus G. So D1 could also be calculated by starting with what we know about the most recently paid dividend, D0, and multiplying it by 1 plus the growth rate in dividends. R in the denominator is the discount rate, and this is what we are also calling cost of equity in chapter 14. And G is the rate at which dividends are growing every year. Okay, so if we take this formula, and you can again imagine 2 versions of it, which is also how I was explaining this topic in chapter 8, with the first formula for calculating the stock price today, having dividend next year, D1 in the numerator, and the second version of the formula having instead D0 times 1 plus the growth rate in the numerator. So if you start with these formulas, you then want to rearrange it, each version of it, to solve for R, because R is the cost of equity, the discount rate. If you rearrange the first formula, you get R equals D1 divided by price 0, and then you add lowercase g to this fraction. Again, this is something that came up at the end of chapter 8, in which we were looking at how the return on a stock investment can be explained as, 2 sources of your the gain in your money, the dividend yield and the capital gains yield. Anyway, we're not talking about that this time. We are kind of just reviewing the sort of the basics of the return on stock investment. If you instead take the second version of the stock price formula using this dividend growth model approach and rearrange it to solve for R, which in this chapter is what we mean by cost of equity from the firm's perspective, then R will equal in the numerator D0 times 1 plus G, in the denominator price today, P0, and then to the whole fraction you add lowercase g, the growth rate in dividends. Okay, so P0 is stock value or stock price today, D0 is dividend that has just been paid or current dividend, D1 is dividend that will be paid next time, usually in 1 year, G is the annual growth rate in dividends in percent, and R is also in percent. That's the annual discount rate or the return on stock investment from the investor's perspective, or in chapter 14, from the firm's perspective, this is the cost of equity. Okay, so we have just reviewed the formulas that allow us to calculate the R, the cost of equity. Let's do some examples. Your company is expected to pay a dividend of $1.50 per share next year. There has been a steady growth in dividends of 5.1% per year, and the market expects that to continue. The current stock price is $25. What is the cost of equity? So you're given the dividend next year, the growth rate in dividends, and the current stock price. This is exactly the three things that you need in order to use. Let me go back to slide 14. In order to use the dividend growth model approach. For the other approach, which we will review next, it's completely different information that needs to be given. Okay, so let's solve this numerical example. Remember, we had a couple of versions of the formula to calculate the cost of equity using the dividend growth model approach. Because $1.50 is the dividend that will be paid next year, we use the version, so let's go back one slide 17. We use the first one of the two versions of the formula to find the cost of equity. The one that says D1 over P0, and then you add lowercase g. So we are using this formula, and we just plug in all the numbers. No tricks here. The difficult part was, I guess, figuring out the right formula to use. And you just plug and check. $1.50 divided by $25. Then, once you have calculated this part, you add in decimals 0.051, the growth rate in dividends. And in decimals, you get 0.111. What does it mean? It costs the company 11.1% per year to use money, whatever the dollar amount is, received from common stock issues. So let's say if a company sells a share of stock with growing dividends to an investor who pays $100 to buy that share, then in return, every year, the firm will be paying $11.10 every single year forever. That's the annual cost to this company to use, the money, the $100 provided by the stock buyer. Next, the growth rate in dividends in the problem we just looked at was given. That was 5.1%. But what is this growth rate really? It's the expected rate of growth in dividends every year in the future. So how could anybody know what the future will look like? So we cannot really know the future growth in dividends every year in perpetuity. In real life, where would this growth rate in dividends in future years be coming from? Maybe we know the past growth rates. Let's say we look back at the last maybe 5 years, and we see the rate at which the dividends have been growing over the last 5 years, and maybe the growth rates were kind of close together. So we just take their average and say, okay, that's probably how it's gonna continue into the future. So we use the past average growth rate in dividends over maybe the recent number of years, and use it as an estimate for the future growth rate, which is what the formula needs to have. For example, maybe to estimate the future dividend growth rate every year, we look back at the last several years, 2014, 2015, 16, 17, 18. And we already know how much money was paid in dividends per share at those points of time. So let's say in 2014 the dividend per share was $1.23. In 2015 it was $1.30. Then $1.36, $1.43, and $1.50. We don't know the growth rates, but we know the dividend amounts in dollars. Can we find the growth rates? Can we find the annual dividend growth rates? What about going from $1.23 in the year 2014 to $1.30 in the year 2015? What's the implied growth rate in this dividend amount? Well, I always tell my students in any class I teach, whether it's real estate or finance or econ, that the percentage change or the growth in anything is new minus old. That's the difference. Like in our example, that would be in dollars, right? The dollar change. And then to get the percentage change, you divide by the old number. So new minus old, and then you divide by old. So $1.30 minus $1.23, that's a 7-cent increase, right? And then you divide by $1.23, which is kind of your reference point, what you're referring to estimate the change relative to that starting point. And that's a 5.7% increase in the dividend amount. Then using the same new minus old divided by old calculation, we can calculate the actual growth in dividends from 2015 to 2016, $1.30 and $1.36. It's a 6% increase, or a 4.6%, 6-cent increase, which is a 4.6% increase, or the growth rate in dividends for that year. Then for the year after, we have $1.43 minus $1.36 divided by $1.36. The increase in dividends was 5.1% over that 1 year period. And for the last year, the dividend went up from $1.43 to $1.50. That's a 7-cent increase. We divide that by $1.43 and get 4.9%. So how can we use these historical dividend growth rates for the last 4 years to estimate what we think the growth rate is likely to be in the future, like starting here 2019? Well, maybe we can just take the average of these 4 growth rates. So we take a simple average, 5.7% plus 4.6% plus 5.1% plus 4.9%, and then we divide the sum by 4, which gives us 5.1% estimated growth rate, lowercase g. So maybe in the previous example, where 5.1% future annual growth rate in dividends was given, maybe it came from this historical information on dividends over the last few years. Okay, so the dividend growth model approach was one of 2 formulas that we can use to calculate the cost of equity, which is how much it costs the firm every year to use money provided to it from the investors who bought its common stock shares or equity. Let's summarize the advantages. According to the book, it's easy to use. Okay, no other advantages, I guess. Disadvantages, if you think about it, what does the formula require us to know? The dividend in dollars, either today's or next year's, the growth rate in dividends, and then today's stock price. If you just look back at the formula, you will see that those were the 3 things. So how about companies that are maybe temporarily not paying any dividends? Then we don't know the dividend amount in dollars. Can we use this formula? No. So what can we use? We'll have to use something else. Also, another disadvantage of the dividend growth model approach is that it's not applicable if dividends are not growing at a reasonably constant rate, because the formula kind of forces the growth rate, the lowercase g, to be the same every year in the future in perpetuity. Then the third disadvantage is that the cost of equity calculation is extremely sensitive to the estimated growth rate in the dividends. So if we are a little bit off in, like, maybe we are 1% off in what we are using for the G, right, the growth rate in dividends, then we will also be 1% off in our cost of equity. And that might be like the difference in like tens of thousands of dollars from the firm's perspective. Then another disadvantage is that the formula does not consider the risk of the cash flows to the stockholders. Because technically, you know, high risk, high return, this term, I've been using it a lot during my last couple of chapters. So, and we're talking about return, although from the firm's perspective, the cost of equity. But where is the risk part? So this formula doesn't consider risk at all. But the other approach that we will switch to on the next slide does consider risk. So the second approach is the security market line SML approach, or instead you can call it the CAPM, Capital Asset Pricing Model approach. Here we don't need to know the things that we do need to know to use the first approach, the dividend growth model. We don't need to know the dividend amount. We don't need to know today's stock price or the dividend growth rate. Instead, we need to be given completely different set of information. And that's what the CAPM formula from chapter 13 contains. So from chapter 13, to calculate the return on stock investment, we take the risk-free rate, RF, and then we add the beta for the stock, the measure of the stock's systematic risk, multiplied by the difference between the expected return on the market portfolio and the risk-free rate, RF. So you need to know three things: the risk-free rate, the beta, or the measure of systematic risk for that stock, and the expected return on the market portfolio. So completely different three things from the three things that the other approach requires us to know. So again, just to remind you what that CAPM model was about, it was about the relationship between, risk or systematic risk and return for any financial security. Essentially, high risk, high return. The higher the risk, the higher the return. The security market line illustrates this positive relationship between risk and return. So that's kind of what that CAPM model was all about. But here we're just, we're focusing on the equation for the CAPM, the security market line, or the CAPM's main formula. Okay, let's review the CAPM formula with the following example. eBay has an estimated beta of 1.35. US Treasury bills are paying about 4.9% return. The market risk premium on large company stocks is about 8.5%. What is eBay's cost of equity? We are given the beta, the Treasury bills, which is the risk-free rate, and something about the large company stocks. So there is one little trick in in the calculations. We do need to use the security market line approach because That's where we need to use things like the beta and the risk-free rate. The formula says the cost of equity from the firm's perspective, which is the same thing as the return on stock from the investor's perspective, should equal the risk-free rate RF plus E-base beta multiplied by, open parenthesis, expected return on the market portfolio minus the risk-free rate. The trick that I mentioned is that 8.5%, which is given, is not the expected return on the market portfolio. It's market risk premium. By definition, it's expected return on the market minus the risk-free rate. So what 8.5% is in this formula, it's the entire term in the parentheses. How would this problem be reworded if we were actually given the ERM part, the expected return on the market? The problem would need to instead say the expected return on the market portfolio or the expected return on large company stocks is so and so %. But that's not the case here. Okay, so the rest is just plug and check. Cost of equity equals, in decimals, risk-free rate 0.049 plus beta is 1.35, and we multiply the beta by risk premium for the market, 0.085, which gives us 0.1638. That's in decimals, which is 16.38%. Let's interpret this number. It means it costs the company, it costs eBay company 16.38% per year to use the money raised from common stock issues. In other words, if eBay sells a share of stock for $100 and somebody pays $100 for the stock, then in return, every year in the future, this firm is obligated to pay back $16.38. So 16.38% of $100, hypothetically, if that's what the stock share costs, is $16.38. That's the cost of equity to this company every single year. That's the money that would be going back from the company to the investor who bought this company's shares. Let's summarize the advantages and the disadvantages of this security market line or the capital asset pricing model approach. Advantages: it does account for risk in the formula, which is the beta part. It's also applicable to all companies, regardless of whether they're currently paying dividends or not. Remember, that was the issue with the other approach, the dividend growth model approach. Here it's not an issue, it can be applied to any company as long as we can estimate beta. In this class, we actually skip the calculation of beta. There's actually a formula which uses covariance and two standard deviations, or it can instead use the correlation coefficient, so something very complicated. We just looked at kind of the end result. The beta could be above 1 or below 1 or exactly 1, which is for an average stock in the economy. Disadvantages. All the disadvantages, all three, have to do with the idea that everything that the CAPM formula contains has to do with the future. So expected return on the treasury bills, expected beta. So things are changing over time. What the current beta is not necessarily what it will be like in 3 years and 4 years and so on. So everything is expected, and that's always an issue. So we need to estimate the expected market risk premium, which varies over time. What also varies over time is the expected beta. And because to estimate what may happen in the future, we typically use past information to predict the future, that may not always be accurate, because a lot of things will change between today when we are making our estimates and some point of time in the future. So do you need to, so how do you know which approach to use, the dividend growth model approach or the SML or CAPM approach? It's you're either given in the problem, like explicitly use so and so approach, or you kind of looked at what's given to see, okay, do I have everything I need for approach number 1? Yes or no? Do I have everything I need for approach number 2? Yes or no? And typically you realize right away that, okay, I can only use approach number 1 or only approach number 2. But is it possible that you're looking at a problem that you need to solve in which you're given the information that allows you to use both approaches? So yeah, it's possible. Let's look at an example like that. So let's do a numerical example that calculates cost of equity using both approaches, the dividend growth model approach and the SML or CAPM approach. So let's say we have a company called Alpha. Alpha stock has systematic risk of 1.2. That's the beta. The market risk premium is 8%. Market risk premium is the difference between the expected return on the market portfolio and the risk-free rate. Then we know the T-bill rate, 6%. That's R subscript F. These three numbers is exactly what we need in order to use what we called approach number 2, the CAPM approach. Now let's look at what else is given. The last dividend that Alpha paid was $2 per share, so that's D0, subscript 0. Dividend is expected to grow at 8% indefinitely, that's the growth rate, lowercase g. Alpha stock currently sells at $30, that's today's price, P subscript 0. And the last three, the dividend, the growth rate in the dividends, and today's price, is what we need to use approach that we called approach number 1, the dividend growth model approach. So we can use either approach. Let's calculate the cost of equity. What are we going to do? If we use the dividend growth model approach, then we would need to take the most recently paid dividend, $2, multiply by 1 plus 0.08, which is the growth rate in dividends. Then we divide the result by $30, today's price. And then we add 0.08, the growth rate in dividends again. So we followed the formula which says D1 over P0, and then we add G. This gives us 0.152, so 15.2% per year, the cost of equity to the firm. We can also use the security market line approach, right, from the first three numbers that are given to us in this problem. That's the CAPM equation. The risk-free rate is 6%, in decimals 0.06, plus the beta is 1.2. The beta is then multiplied by 8%, the market risk premium, which is given, and we get 0.156 in decimals, which is the cost of equity of 15.6% to the firm. Well, the two numbers, 0.152 and 0.156, are pretty close. So what we can do is we can, like if you're not sure which approach we should use, then we can just take the average of the two results. And that will become our final answer for the cost of equity. So 0.152 plus 0.156, the sum is divided by 2 and gives us 0.154, which we interpret as always the following way. It costs the company 15.4% per year to use the money raised from common stock issues. maybe you always trust the SML approach better because it counts for expected future risk, the beta. So maybe you just don't even do the dividend growth model approach. So your final answer would be 0.156. So what I'm saying is that in a problem like this, you should make probably somewhat a subjective decision on which approach to use, and if you're using both, then how much you would like to rely on this or that approach. Here we kind of did it the simple way. We are basically saying that I like both approaches, I really would like to rely on both approaches, so I'm just taking a simple average of the numbers I get. There is another type of stock that some companies issue, which is known as preferred shares of stock, preferred stock shares. So we've just looked at common stock shares or equity, and now let's see how we would calculate the cost of preferred stock. Okay, from chapter 8, in which we had a brief comparison of common stock and preferred stock, we learned that preferred stock is a form of what we call equity. Preferred stockholders must receive a dividend before the investors who buy common stock shares. This is where the name preferred stock comes from. They have preference in receiving dividends over other investors who hold common stock shares. Preferred stockholders, they only receive a so-called stated dividend, which means it's fixed, let's say $2 every year forever. Whereas with common stock dividends, the dividend may be higher in good years when the company has higher profits, and the dividend may be low or nothing at all in bad years for the company. Then to calculate the value of a preferred stock share, we essentially use the same approach as we do for valuing common stock shares. It's the present value of all future annual dividends. But because preferred stock dividends are fixed every year, it becomes a perpetuity. So we need to find the present value of a perpetuity of future dividends, because it's the same dividend paid every time period forever. So let's review the formula for that. Because it's the same dividend every year forever, to find the stock price today, denoted by capital P subscript 0, where 0 stands for year 0, we need to find the present value of this perpetuity of dividends, which never end. From chapter 6, in which we looked at the calculation of a perpetuity present value, we need to take the repeating cash flow amount, which is the dividend for our preferred stock, and divide it by the discount rate, capital R subscript P. That's what we denoted in this chapter. And in this chapter, the discount rate is looked at from the perspective of the firm that pays, the dividend every year to the holders of preferred stock shares. And we call it cost of preferred stock. So to rearrange this formula to solve for the cost of preferred stock, or RP, we need to take the dividend amount and divide it by the present value, which is the stock price today. So rearranging gives the cost of preferred stock formula. RP, cost of preferred stock, equals the dividend amount divided by the price per share today. Let's look at this example. A firm has preferred stock with an annual dividend of $3. Current stock price is $25. What is the cost of preferred stock? Solution, using the cost of preferred stock formula, RP, which is the cost of preferred stock notation, equals dividend D divided by price per share today, capital P subscript 0. So we plug in the numbers. The dividend is $3. and we divide it by the price per share of stock today, $25, which gives us 0.12 in decimals, or a 12% cost of preferred stock, which can be interpreted as it costs the company 12% per year to use money raised from preferred stock issues. So when one share is sold and an investor pays $25 for it, then in return for using $25 for the firm's businesses, the firm is going to be required to pay back every year forever $3, which is a 12%, 12% of out of $25. So $3 going from the firm to the investor every year forever is 12% kind of cost of using $25. Okay. And now let's look at the other source of capital for a firm, which is selling corporate bonds to borrow money from investors. So again, the money that goes back from the firm to the bond buyers is what we call cost of debt or cost of raising debt. From the investor's perspective, it's the return that they get every year when they pay money to buy the bonds. So that technically includes corporate bonds and also long-term loans, but we will be only talking about corporate bonds on the next couple of slides. So cost of debt, the notation is R, capital R, subscript, capital D, RD, is actually nothing but the discount rate that we use in bond problems. The term we were using in Chapter 7, in which we were covering bonds, is yield to maturity, abbreviated as YTM. So yield to maturity is basically the discount rate for bonds or the cost of debt, one and the same thing. And just to remind you about bond calculations, there are two percentages that are given in bond problems. One is the discount rate, or the yield to maturity, or the cost of debt. And the other percentage that's usually given is the coupon rate. So coupon rate is not cost of debt. What's cost of debt is the discount rate, or the yield to maturity. Okay, again, this is just a review of what we did when we talked about bonds in Chapter 7. So let's do, a refresher problem. Suppose we have a bond issue currently outstanding that has 25 years left to maturity. The coupon rate is 9% and coupons are paid semi-annually. By the way, this is a key word you should always check for before you start solving a bond problem. Are coupons annual or semi-annual? The bond is currently selling for $908.72 per $1,000 bond. What is the cost of debt? Solving for the cost of debt is the same thing as computing IY, the discount rate for the bond, for which we need to know four things. N, which is how many coupon payments there will be between now and maturity. PMT, which is the coupon payment itself. FV, which is the future value, but it's also the face value, which is typically $1,000 on a bond. And PV, the bond present value, which is also nothing but the price per bond today. So N, how many coupons? Because there are 25 years left to maturity and there are semi-annual payments, 2 per year, we have a total of 25 times 2 equals 50 coupons between now and the maturity of these bonds. PMT, the coupon amount itself. We always calculate the coupon amount the same way. We take the coupon rate, that's 9% in our problem, and multiply by $1,000. That would be the coupon amount per year. However, again, we need to adjust this number for the frequency of the coupons, because they're paid semi-annually, every half a year, the coupon amount is half of the annual coupon amount. So coupon rate times $1,000, and then we need to divide it by 2. Plugging in the numbers, 0.09 coupon rate times 1,000 divided by 2 gives 45. So $45 every half a year, that's the coupon payment. FV, that's the face value on the bond paid at maturity at the very end in the future. That's always 1,000. PV, that's the bond present value or price. That's given, 908.72. Notice how I put the signs. This is something I was also emphasizing in chapter 7 when we were covering bonds. Everything that's today is one sign. Everything that's in the future is with the opposite sign. So I used a negative sign for today's price on the bond, which means I need to use a positive sign for both the face value and the payment amount, the coupons. Or I could switch the sign. So I could also instead use minus 45 for the coupon amount or PMT and minus 1,000 for the face value of the bond or FV. In that case, I would need to keep the bond price, which is PV in the calculator, as positive 908.72. Okay, so let's bring up the financial calculator. Turned on. N is 50, so I put 50 N. Then I put the payment amount, which is 45 PMT, and with the same positive sign I am entering the face value of $1,000 as my FV, future value. 1,000 FV. PV is negative 908.72, so 908.72, then I'm changing it to negative plus minus scheme, and then I save it as PV. And I'm computing IY. So I press compute and then IY. 5%. However, as this slide then shows, this is not what we call cost of debt, because what all these terms that we are learning in this chapter, cost of common stock, cost of preferred stock, and cost of debt, they all are per year. Is 5% the discount rate per year? No, it's per half a year. And that's because of the semi-annual frequency of the coupons for this bond. And so what we need to do to get the annual discount rate or the cost of debt, we need to then multiply 5% by 2 to give us 10. So 10% per year is the cost of debt in this problem. And now, interpretation. It costs the firm 10% per year to use money raised from bond issues. So if a firm sells $100,000 million worth of new bonds, then it will cost the firm 10% of that per year. So 10% of $100 million is $10 million. So it will be paying $10 million to the investors every single year for the money that the investors have provided. Okay, so let's go back to the formula that we are trying to build throughout this chapter. You're trying to build the formula that we call the weighted average cost of capital, or WACC. Students often call it WACC. It has to reflect some sort of average of the cost of equity, RE, cost of preferred stock, RP, and cost of debt, RD. We have just reviewed the calculation of each of these three costs. And now we need to connect them. So if a firm has all three in its, as we say, capital structure, so it uses money that comes from bonds and preferred stocks and common stocks, then we need to use some sort of average of the cost of equity, cost of preferred stock, and cost of debt. We call it the weighted average. So should we just sum up the three costs, RE plus RP plus RD, and divide them by 3, which will be the simple average of the 3, to give us the weighted average cost of capital? Turns out that's generally a wrong approach, because adding the 3 and dividing by 3 is the simple average, which means you're implying that the firm has the same dollar amounts of equity, preferred stock, and bonds in its capital structure, because it's the same thing mathematically as 1/3 times the cost of equity, RE, plus 1/3 times the cost of preferred stock, RP, plus 1/3 times the cost of debt, RD. In general, this of course doesn't have to be true. In general, firms may have a lot more money that's borrowed rather than what's sort of provided by the company owners. So what does the weighted average mean? What would be the correct way of calculating the average of these 3 costs? We need to multiply each of these 3 costs, 3 R's, by its own weight. So the weight of equity in firm's capital structure multiplied by the cost of equity, RE, plus the weight of preferred stock in firm's capital structure multiplied by the cost of preferred stock, RP, plus the weight of debt in firm's capital structure multiplied by the cost of debt, RD. And the key here is these 3 weights, they don't have to equal, they can be completely different fractions of the firm's capital structure, firm's value, in other words, but they must add up to 100%. So how can we calculate firm's capital structure weight? Let's look at that next. The weights are determined by how much money in dollars of each type of financing is used by the firm. So you can imagine this pizza-looking image, which is the value of our firm, and you kind of split this circle into 3 sectors, and the sizes of the 3 sectors are not necessarily the same. So one sector is equity, another sector is debt, and the last one is preferred stock. And we need to find the value of these 3 sections of the firm value. So we say that the market value of a firm, which we denote by V, equals the sum of market values of equity, or E, preferred stock, or P, and debt, D. So V equals E plus P plus D, all in capital letters. What do we mean by market values? It means, so there's actually a difference between market value and book value. So for example, let's look at the first component of this sum, E, capital E, which stands for equity. What would be the market value of equity, and what would be the book value of equity? The market value of equity would be equal to the number of shares of stock currently outstanding multiplied by today's price per share. The book value would be equal to the number of shares outstanding multiplied by the price per share when stock was issued originally, maybe a number of years ago. So the market value reflects the market price per share, or today's price per share. And that's what really determines, how much a firm is currently worth. Everything is based on current values of everything that comprises the firm value. The same thing can be said about the market value of preferred stock, which is capital letter P in our firm value formula. We need to multiply the number of shares outstanding by today's price per share rather than the price per share when stock was issued, which would be the book value. And for bonds or debt, which we denote by capital D, and that's the third component of the firm value, the market value would be equal to the number of bonds outstanding multiplied by today's price per bond. If you instead multiply by the $1,000 face value, that will give you the book value of bonds. And that's kind of something that's static over time. It doesn't change, just like the book value of preferred stock and common stock shares. But the market values is something that's not static. It may be changing over time, right? Stock prices fluctuate over time, and so do bond values. So it's the market value of everything that goes into the calculation of the firm value, as well as the weights, which is our goal. So how do we then apply the market values of the three components of the firm value to calculating the weights? Well, mathematically, we need to divide both sides of our firm value formula by the firm value, by capital V. And then mathematically, we would just have V divided by V on the left hand side, which is simply 1, and that equals on the right hand side E divided by V, and that's the weight of equity, so some percentage out of 100%, plus P over V, the weight of preferred stock. Again, it's some percentage out of a total of 100%, plus D over V, the weight of debt. So 1 on the left hand side is the same thing as 100%. So the total sort of kind of value of the firm. And the three terms on the right hand side are capital structure weights, and they must all add up to 100%. So weight of equity, E over V, weight of preferred stock, P over V, and weight of debt, D over V. Three weights in the firm's capital structure. Now let's look at a couple of examples. A firm has a market value of equity equal to $300 million and a market value of debt equal to $100 million. Total market value of the firm is $600 million. What are the capital structure weights? So there are three weights that a firm's capital structure generally has: weight of equity, weight of debt, and weight of preferred stock. Let's see what we are given. We are given market value of equity. We are given market value of debt. Looks like we are not given anything about preferred stock. Does it mean we don't have any? Actually, we do. Because if you add up equity and debt, 300 million and 100 million, you will get 400 million. So, and that doesn't match the total market value of the firm, which is 600 million. So there's another 200 out of 600 million that equity and debt do not kind of reflect. And that must be the preferred stock value. So to find the weight of equity, we divide E by V, equity value, market value, by firm's total market value. 300 million over 600 million, which gives 0.5 or a 50% weight. The weight of debt is calculated similarly, D divided by V. The market value of debt is 100 million. We divide that by the market value of the firm, 600 million, which gives 0.167 or 16.7% as the weight of debt. And the weight of preferred stock can be calculated, for example, by taking 1 and subtracting the two weights in decimals. So 1 minus 0.5 minus 0.167, which gives 0.33 or 33%. Or you could also find the weight of preferred stock the same way you found the weights of equity and debt. Because once you figure out that there is $200 million hidden in this problem in the market value of preferred stock, you can then take 200 million and divide by 600 million, the total firm value, which would also give you the same weight as a result. Let's look at another example in which you're asked to calculate the capital structure weights. A firm has 100,000 shares of stock outstanding and 300,000 corporate bonds in the hands of its investors. Stock is currently worth $150 per share, and bonds are sold for $980 each. What are the capital structure weights? Okay, so there's actually no preferred stock in this problem. The problem just says shares of stock and bonds, corporate bonds. Usually when you see just stock without like a clear, name for it, common stock or preferred stock, you should always assume the common case, which is the common stock. So here, shares of stock really means shares of common stock, and there is no preferred stock in this firm. Okay, because there is no preferred stock, the formula to calculate the total market value of the firm simplifies to just the sum of two terms: E, equity market value, plus D, debt market value. Okay, how do you find the market value of equity and the market value of debt? By definition, market value of equity is the number of shares of stock times the price, the market value of its share, or nothing but today's price per share. So here the wording is stock is currently worth 150 per share. That refers to today's market value of each share. So the market value of equity equals 100,000 shares multiplied by $150 market value per share, which gives $15 million. Similarly, we can calculate the market value of debt, which is the number of bonds, 30,000, multiplied by the market value of each bond, $980. How do we know that 980 is market value rather than book value? First, book value is usually $1,000, like the face value of each bond. And second, the wording. Bonds are sold for this much each. So this refers to the price that you will be paying today, which is the market value. Okay, so 30,000 times 980 gives $29.4 million. Then we can combine the two market values for equity and debt, which will give us the total firm's market value, capital V. So 15 million plus 29.4 million gives 44.4 million. That's the total market value of the firm. And then we have everything we need to find the weights. Weight of equity and weight of debt. Weight of equity is the percentage or the proportion of the market value of equity out of the total market value of the firm. So we take 15 million and divide by 44.4 million, which gives 0.34 or 34%. And the weight of debt is calculated similarly. We take 29.4 million, the market value of debt, and divide by 44.4 million, the market value of the entire firm, which gives 0.66 or 66%. Of course, there's one more way of calculating the weight of debt once you already have the weight of equity. You can just take 1 and subtract the weight of equity in decimals, 0.34, which gives 0.66 or a 66% weight of debt. Okay, let's go back to our weighted average cost of capital formula. We know where the weights are coming from. We know from even earlier slides how to find the cost of equity RE, the cost of preferred stock RP, and the cost of debt RD. Turns out that RD is the so-called pre-tax cost of debt. Um, there's something called after-tax cost of debt, where we take RD and multiply by 1 minus the corporate income tax rate, denoted by capital T subscript capital C. What we need to use in the WACC formula is actually the after-tax cost of debt. Why is that? That's because loans for businesses that include bonds, for example, that firms issue, have tax-deductible interest payments. And effectively, when you get kind of a tax break for a huge portion of your expenses, effectively the interest rate on debt becomes smaller. And RD multiplied by 1 minus TC is exactly what the correct or effective cost of debt is to the firm when the tax deductibility of interest payments is considered. Okay, so finally we are done with building the weighted average cost of capital formula. Let's review. Weighted average cost of capital equals the weight of equity, which is calculated by taking the market value of equity and dividing it by the market value of the firm, multiplied by the cost of equity, RE. Then we add a similar term for preferred stock, which is the product of the weight of preferred stock calculated as the market value of preferred stock shares divided by the market value of the entire firm. And then this weight of preferred stock is multiplied by the cost of preferred stock, RP, plus the last term for the debt amount. The weight of debt, D over V, where D stands for market value of debt and V stands for the market value of the entire firm, multiplied by the pre-tax cost of debt, RD, times 1 minus TC. So RD times 1 minus TC is all the after-tax cost of debt. Just RD is the before-tax cost of debt. This is, this long formula is how firms can calculate, on average, from all the money that different investors provide to the firm by buying the firm's bonds and different types of stocks. On all that money, how much it will cost the firm every year. So how much the firm will be paying every year as a percentage of everything that it received from the investors. That's the weighted average cost of capital. Let's do the following example. The question is, what is the firm's weighted average cost of capital? And let's see what we are given about the firm. This firm finances its operations by issuing equity and debt. So right away you see that there is no preferred stock in the picture, just common stock or equity and debt. And then we are given two columns. In the first column we have equity information. In the second column we have debt information. Let's see what we know about equity. The firm has 50 million shares, $80 per share, beta equals 1.15, market risk premium equals 9%, risk-free rate equals 5%. Debt information, $1 billion in outstanding debt. In parentheses, I explain that this is nothing but the total face value of all bonds. Then we know current quote equals 110, coupon rate equals 9%, semi-annual coupons, 15 years to maturity. And we are also given the tax rate for this firm in the amount of 40%. Okay, let's calculate this firm's weighted average cost of the capital. This is the WACC formula, the weighted average cost of capital formula. On the right, I have like a small image of the previous slide with all the information that's given, so we can kind of look things up. Right away, you can cross out the part of the WACC formula related to preferred stock because we don't have any preferred stock. Let's start by calculating RE and RD. RE, cost of equity. Remember from way back when in this chapter, one of the very early slides, we looked at two approaches, two different formulas, and you use the right one based on what you're given. Two different formulas how the cost of equity can be calculated. Because we are given the beta, the market risk premium, and the risk-free rate, we can use the CAPM approach, the capital asset pricing model approach, which says to calculate the cost of equity, we take the risk-free rate, we add the product of the beta and the difference between the expected return on the market portfolio and the risk-free rate. So let's plug in the numbers. The risk-free rate is 5%, I put 0.05 in decimals, plus the beta of the stock is 1.15, so I add 1.15 multiplied by, and then I just put one number, 0.09, which is the market risk premium of 9%. And the reason I'm not subtracting the risk-free rate, like the CAPM formula says, is because the market risk premium is already the difference between the expected return on the market portfolio and the risk-free rate. So 9% that's given to us is the entire term in the parentheses. It's not just ERM, it's ERM minus RF. Okay, so the calculations give us 0.1535, which is 15.35%. So 15.35% is what it costs the firm every year to give back to stockholders for the money that they provided for the firm. So out of the money that they provided to the firm for its businesses, 15.35% of that needs to go back from the firm every single year. That's the annual cost of equity. Then pre-tax cost of debt. Let's do this part of the WACC formula. RD, that's pre-tax cost of debt. It's the same thing as computing IY in a bond problem. Okay, so to compute IY, we need N, the number of coupons, PMT, the coupon amount itself, FV, which is the face value on the bond, and PV, the bond price. What is N? Let's see what we are given. 15 years to maturity, semi-annual coupons, which means 2 per year. Over 15 years, there will be a total of 30, which is 15 times 2. Next, PMT, that's the coupon. Because of these semi-annual coupons, we need to find the semi-annual coupon amount. Per year, it's coupon rate times 1,000. The coupon rate is 9% given. When multiplied by 1,000, it gives $90. Then we divide it by 2, which gives $45 per half a year. FV, the future value or the face value is always $1,000, even when it's not given. Just assume it's always $1,000. So I put that. Notice that I'm using both PMT and FV with a positive sign, which means that the present value must be with a negative sign. So what is the present value on each bond? What is the price for each bond? Let's see. What else do we know about the firm's debt? $1 billion in outstanding debt, which is the same thing as the total face value. Current quote equals 110. That's all we have left to figure out the bond price. Current quote means 110% of the face value. So what's 110% of $1,000? That's 1,000 $100. So I guess a good way to remember the trick to go from current quote, which is how bond prices are sort of quoted in the financial world. How to go from the quote to the price, you just add 1 0. So 110, if you add one more 0, it becomes 1100. That's the price for each bond. And I use a negative sign for it, otherwise the bond calculations will give me an error. Compute IY, the answer will be 3.927. Because it's per half a year, I will need to multiply that by 2 to get the annual cost of debt or pre-tax cost of debt, 7.854%. Let's review the bond calculations in the financial calculator. Let me bring it up. Let me first clear everything from my earlier calculations. Okay, so I have N, which is 30, so I press 30N. Then my coupon payment every half a year is $45. I put 45 PMT. The face value is always $1,000, so I press 1,000 and I save it as FV. And then the bond price is $1,100. I put 1,100, oops, 1,100. I change the sign to negative by pressing the plus minus key on the bottom, and then I save it by pressing the PV button. Compute IY, 3.93% every half a year. Actually, if I increase the decimal places, I would have gotten a more accurate number, 3.927 when rounded to 3 decimal places. And then you multiply that number by 2 to get 7.854%. Next, let's focus on the weights. The weight of equity, and the weight of debt. We know that the market value of equity is equal to the number of shares times today's price per share. So you take 50 million and multiply by $80 per share, which gives $4 billion. Market value of debt. You would want to do the same thing, the number of bonds times the price per bond. What is the number of bonds? If the total face value is 1 billion and the face value of one bond is 1,000, then there must be 1 million bonds. And the price for each from our last slide was $1,100. So you could multiply 1 million bonds by $1,100 per bond, or you could do it a little bit differently. You could use the quote again. So again, the current quote means percentage of the face value. So 110%, 110% of the face value is the market value. And we can apply the quote to the entire book value, the entire $1 billion. So $1 billion multiplied by 110% quote gives $1.1 billion. That's the market value of that. The sum of the market values gives the market value of the firm. 4 billion plus 1.1 billion equals 5.1 billion. Then we can calculate the weights. The weight of equity is 4 billion divided by 5.1 billion, which gives 0.7843 or 78.43%. The weight of debt is 1.1 billion divided by the same total, 5.1 billion, which gives 0.2157 in decimals, or 21.57%. So these are our two weights that will then be used in the weighted average cost of capital formula. Of course, the weight of debt could be calculated slightly differently because there are only two things in the firm's capital structure, and we already know the weight of the first, 78.43%, the weight of equity, we can just subtract the weight of equity from a total of 100%, or in decimals, 1 minus 0.7843, which gives 0.2157, the weight of debt in decimals. Okay, so we have just calculated all the components of the WACC formula that needed calculation. The weighted average cost of capital now equals the weight of equity, 0.7843, multiplied by the cost of equity, 0.1525, plus the weight of debt, 0.2157, multiplied by the pre-tax cost of debt, 0.07854, times, in the parentheses, 1 minus the corporate income tax rate, 1 minus 0.40, which is given. This gives us 0.1306 or 13.06%, which means overall, considering all the different sources of money for the firm, it costs our firm 13.06% per year to use the money that was provided by the investors into the firm who bought the firm's common stocks and bonds. Let's take one more step, one step further, kind of beyond what this problem asked us to calculate. What we can now say is that if this firm is considering a new investment project, it should accept the project only if it expects to earn no less than a 13.06% return. Otherwise, the project will not be profitable enough and the firm won't have enough money to compensate its investors. Let's look at the following example. A company wants to invest $300,000 into a new factory in Texas. The factory is expected to generate profits equal to $150,000 per year for 3 years. What do we know about the company? It issues debt and equity in equal proportions. The beta of its equity equals 1.2. The yield to maturity on its bonds is 10%. Its corporate income tax rate is 34%. We also know that the risk-free rate in the economy is 3% and the expected return on the market portfolio is 20%. The question in this problem is, should the company make the investment? Let's see how we should approach this problem. To answer the big question, should the company make the investment, essentially we would need to calculate the project's net present value. So we need to discount the future cash flows estimated for this project in order to calculate the project's net present value. The project's cash flows are given. We need to invest $300,000 and this 3-year project will generate $150,000 per year. So the cash flows are not a problem, but what we need for the net present value, apart from the cash flows, is the discount rate, project's discount rate. For that, we can use the weighted average cost of capital. So our very first step will be calculating the cost of equity, the cost of debt, and their weights in order to find the weighted average cost of capital, which will then be used as the discount rate to find the project's net present value. So this is our plan. Let's start with the weighted average cost of capital formula. Once again, we only have 2 parts in it rather than 3 because we don't have any preferred stock, just debt and equity. So we have the equity component in the WACC formula and the debt component in the WACC formula. Let's start with the cost of equity, RE. What are we given about the common stock shares? The beta, the risk-free rate, and the expected return on the market. These three are part of the capital asset price and model formula, which is the approach we can use to find the cost of equity. So from the CAPM approach, we have the risk-free rate, 3% or 0.03 in decimals, plus the beta of the stock, 1.2, multiplied by the expected return on the market, which is 20% or 0.2 minus the risk-free rate, 0.03. This gives us 0.234 or 23.4%. So on the money provided by investors who buy the firm's common stock shares, it will have to pay back every year 23.4% of that money. That's for the common stock part. Now, what about the bonds? So let's calculate the cost of debt, which is denoted by RD, which is also the same thing as the pre-tax cost of debt. The yield to maturity is 10%. It's already given. So there's nothing we really need to calculate. We don't need to solve any bond problem for IY. We already know the pre-tax cost of debt. Okay, then the tax rate, the corporate income tax rate, TC, that's also given, 34% or 0.34 in decimals. Then what we are left in the WACC formula is the capital structure weights, the weight of equity, E divided by V, and the weight of debt, D divided by V. Let's see what we are given. The company issues debt and equity in equal proportions, which means both weights are 50% each, or 0.5 in decimals. Okay, let's put all the numbers together. The weighted average cost of capital in this problem equals 0.5, the weight of equity, multiplied by 0.234, the cost of equity, plus the weight of debt, 0.5, times the pre-tax cost of debt, 0.10, times 1 minus the corporate income tax rate, 0.34. This gives us 0.15 in decimals or 15%. 15% is how much it costs the firm every year on the money that stock and bond buyers provided to the firm. And so this is the minimum the firm should want to earn on any new investment project. So we are now using 15% as the discount rate for the project in our problem. The net present value equals minus the initial investment, minus $300,000, plus the first year's cash flow, $150,000, discounted back by 1 year, so divided by 1 plus 0.15, the WACC. Then we add the discounted second year's estimated cash flow, $150,000 divided by squared sum of 1 and 0.15. And then similarly we add the last discounted cash flow, the third year's $150,000 cash flow divided by cubed 1 plus 0.15. This gives us the net present value of $42,484. Of course, this whole thing, the net present value step, could be calculated in one step in the financial calculator using the cash flow keys. Let's review that. Okay, let's clear everything. I'm pressing second plus minus enter. I press the cash flow button. For year 0, we have the initial investment of $300,000. So I press that, 300,000. I change the sign to negative by pressing the plus minus key on the bottom. And then I save it by pressing enter. Then I press the down arrow key. It takes me to cash flow number 1 in the future, which is the first year's estimated cash flow, $150,000. $150,000. I save it by pressing enter. I press the down arrow key. The calculator is asking me about the frequency of the cash flow I have just entered. And this is where we can speed things up a little and change the frequency to 3, because we have $150,000 repeating consecutively 3 times. I press 3, enter, down arrow key. Cash flow number 2, after my first cash flows have been saved. There is no cash flow number 2. That's it, we are done. Now I press NPV. The display asks me about the I, which is the interest rate or the discount rate. That's 15% weighted average cost of capital. I press 15, enter, down arrow key, and the last thing I press is the compute button, CPT. $42,483.77, or approximately $42,484, like I calculated on the slide earlier. And now let's interpret this result. Because the net present value is above $0, the project is worth it. Now let's look at some issues with the weighted average cost of capital. To be precise, we are looking at the problems with using the weighted average cost of capital as the discount rate for any new investment project that a firm may be considering. So the weighted average cost of capital approach tells us that the return on an investment should be at least as high as the firm's overall weighted average cost of capital. So that's basically saying that we use the firm's weighted average cost of capital as the discount rate for any new project. Turns out we can do that. So we can use the firm's weighted average cost of capital as the discount rate for any new project. It's only appropriate for projects that have the same risk as the firm's current operations. Because if there is a project that's much riskier, less certain cash flows, which implies less certain dividends to the stockholders, then there should be compensation for the stockholders for facing a lot larger risk. High risk, high return, right? So the return that the investors will expect from a riskier project should be higher. That's from the CAPM formula, for example, where we have the beta, the risk measure. And so this means mathematically, in our net present value calculations for a project, the discount rate should be higher than the firm's WACC. The higher the discount rate, the lower the net present value of a project would be. And so it could be that the net present value is negative and the project should be rejected, following the NPV rule. But if we did not adjust the firm's WACC to this higher riskiness of the project, then we might be underestimating the true discount rate, which mathematically may end up giving us a positive net present value for a project that should have a negative net present value if we correctly used a slightly higher discount rate for it. So by mistakenly using firm's weighted average cost of capital rather than the project's weighted average cost of capital, the firm may be mistakenly accepting unprofitable high-risk projects. Also, we can say that the firm may be mistakenly rejecting profitable low-risk projects if it's using its own WACC rather than a slightly lower discount rate for a new project that is not as risky. Where such problem is particularly relevant is a corporation with more than one line of business or divisions. For example, let's say we have a company with 2 divisions and they have different levels of risk. Division A, maybe it's an electric company. It has a low risk, it's a stable business, and the appropriate weighted average cost of capital for this division is 13%. The company also has another division, Division B, doing something similar, electronics manufacturing. However, it's a different product and it's a lot higher risk. And the appropriate weighted average cost of capital for Division B is 17%. What is the company's overall weighted average cost of capital if we sort of aggregate divisions A and B? It's a mixture of these two different weighted average costs of capital, 13% and 17%. Let's say it's somewhere halfway, somewhere in the middle, like 15%. The problem is, if the two divisions are competing for resources, the firm may be incorrectly allocating more money to the riskier division, which is Division B. And if it uses the 15% discount rate to evaluate the projects that Division B would be considering, rather than the correct 17% discount rate, then we might overestimate the net present value for the projects undertaken by Division B. The net present value may look like it's a positive value when in fact, if the 17% discount rate was used correctly, the NPV would have been a negative value. So the company may be incorrectly accepting projects which should be rejected, and as a result of that, it may end up losing money. In real life, firms are aware of this problem when they have multiple divisions, and they're realizing that the correct discount rate to use for a project undertaken by that specific division is to use that specific division's own weighted average cost of capital rather than the firm's overall weighted average cost of capital. So we need to use separate or divisional costs of capital as appropriate discount rates for projects undertaken by specific divisions. In other words, each division should use its own weighted average cost of capital. What may be other ways to figure out a proper discount rate to individual projects or divisions? There's something known in finance as the pure play approach. Pure play in Wall Street language means a company that focuses on just one line of business. So it has a very narrow business. It makes a very narrow product, something very unique, very specific. So our company that would like to undertake a new project that involves producing something specific may want to find one or more companies that specialize in the same kind of product. And we would then use the typical return on these investments from those other companies and sort of borrow it and use it as the discount rate for our product. The problem with the pure play approach may be, what if this new investment opportunity our firm is considering is something that does not have anything like it in other companies? So what if we may not be able to find suitable companies to sort of borrow their typical rate of return and use it for our project discount rate? Then there's another approach we could follow instead, the so-called subjective approach. So we are making subjective adjustments to our firm's overall weighted average cost of capital. Let's say our firm's overall weighted average cost of capital is 15%, but we are considering a project which is a lot riskier than anything we currently have. We may subjectively add, let's say, 6% to our weighted average cost of capital. So what's 15%? Our WACC plus 6% subjective adjustment. That's 21%. So essentially we are saying that, okay, how about we use a 21% discount rate for this high-risk project. If it's a new project with moderate risk, we may not want to make any adjustments. So we may take our firm's overall WACC 15% as is and use it as the discount rate for such projects. And the third possibility is that we are considering a new project which is a lot more predictable in terms of its cash flows. So a low-risk project, a lot less risky than everything else we currently have running. Then we may decide to use not a 15% discount rate, but something lower than that. And we subjectively decide to use a 4% lower discount rate. So 15% minus 4% gives 11%. I think the problems with the subjective approach are kind of obvious. How do we know how much to add or how much to subtract from the firm's overall WACC to make those adjusted, discount rate calculations? Why plus 6%? Why not plus 5% or plus 7%? Why minus 4%? Why not subtracting something a little bit less or more than 4%? These adjustments are kind of almost random, or they are subjective, and that's where the name of this approach comes from. To summarize, using the firm's weighted average cost of capital as the discount rate for any new investment project may not always be correct. It's only correct if that new project displays similar riskiness as the firm's existing projects. Otherwise, we need to adjust our firm's WACC. There are three ways how we can find the correct weighted average cost of capital, or I should say the correct discount rate for a new project. We may use the divisional weighted average cost of capital. So each firm's division may have its own slightly different WACC. That's the proper discount rate for the division that would be in charge of the new investment project. 2, use pure play approach. So we kind of borrow the rate of return that other firms get on projects like the one we are considering and use it for our project's discount rate. 3, use subjective approach. So we take our firm's WACC and subjectively add a few percent or subtract a few percent. If the project we are considering is riskier than our existing projects, or the other way around, if they are not as risky as our firm's existing projects. And now let's look at the last slide, at the last topic in chapter 14. We've been talking about a firm that raises money and it costs the firm some percentage of that money every year. So that's what we call the cost of equity, cost of preferred stock, cost of debt, which combined were called weighted average cost of capital. What we've been ignoring so far is that it costs money to raise money. So when a firm sells shares of stock or sells bonds, it's not free to the firm. The cost of issuing new equity and new debt is called flotation costs. How should we adjust? Should we adjust the weighted average cost of capital upward to reflect these additional costs to the firm? No, that's not the best approach, because the required return on an investment depends on the risk of the investment, not the source of the funds, not how much it costs. Instead, where we're going to be making the adjustment to the flotation costs is the initial investment into the project. We are going to adjust the initial cost of the project upwards. As a result, because the initial investment will be higher, the project's net present value will go down. Let's look at the following example. We want to invest $50 million funded by selling new shares of stock. Flotation costs associated with selling these new stock shares will equal 10%. What will be the true cost of our investment into this new project? Solution. So we need to pay, so it will cost 10% of the money that we need to pay for, some sort of third party that's between investors who providing us their money and our firm. So there's a third party in between that will collect 10% of the money that we are raising from the investors. So we kind of need to add 10% to what we need, right? So we need 50 million. We add 10% of 50 million, which is 5 million, and that would give us 55 million. Unfortunately, while the idea is correct, the calculations are wrong. Because think about like going backwards. We raise $55 million worth of money by selling additional shares of stock, right? And flotation cost of 10% means that 10% of 55 million will be gone, paid to this third party that's helping us go through this issuing process. What's 10% of 55 million? It's 5.5 million. If you subtract 5.5 million from 55 million, we will be left with 49.5 million. But that's not enough for the project. We need 50 million. So 55 million worth of new stock shares is not enough. What is enough? How do we do the calculations correctly? The correct calculations are to follow this sort of backward approach that I now use to show how what we did was wrong. So we sell, some $1 million worth of new shares of stock. 10% of that will be gone. So we multiply that dollar amount by 1 minus 0.1. And that should equal exactly $50 million that we need for our project. Let's rearrange it to solve for the unknown. The unknown dollar amount that we need to raise from stock share issues should equal $50 million that we actually need for our project, divided by 1 minus the flotation cost of 0.1 in decimals. This gives 55.6 million. So 55.6 million is actually just right when we subtract 10% of that. We will be left with exactly 50 million that we need for our project. To summarize, to calculate the amount that needs to be raised, we take the initial investment that's required for our project and divide it by 1 minus the flotation costs, where flotation costs are either in percent or in decimals. So this is not a dollar amount, this is actually a percentage. What if we want to raise money from 2 or maybe 3 different sources? So maybe stocks and bonds, or stocks, common stocks, and preferred stocks, and bonds. And the flotation cost on the two may be very different. Typically, the flotation cost for stocks is higher than the flotation cost for bonds. It's a lot more complicated process to sell new shares of stock rather than to sell new bonds. This is something which is actually covered in the textbook, but the chapter on that is not part of this course coverage. To figure out the overall flotation cost that sort of covers several different sources of financing, of raising funds, we need to calculate the so-called weighted average flotation cost, which we denote by F, lowercase f, and subscript capital A. So A basically stands for assets. So FA equals the weight of equity, just like before, where we take the market value of equity and divide by the market value of the firm overall, multiplied by equity's flotation cost, F subscript capital E. Then we add the same thing for preferred stock, weight of preferred stock times flotation cost for preferred stock. And then we add the last term for debt, the weight of debt multiplied by debt's flotation cost, F subscript D. Let's look at the following example. A company wants to invest $50 million into a new project. 80% will be raised through new equity, 20% will be raised through new debt. Flotation costs on equity are 10%. Flotation costs on debt are 5%. Two questions. What is the weighted average flotation cost? And what is the true investment needed for this new project? To answer the first question, we need to use the weighted average flotation cost formula. Because we're only raising money from two sources, equity and debt, there is no preferred stock part in the weighted average flotation cost formula. So we just have the weight of equity times the flotation cost of equity plus the weight of debt times the flotation cost of debt. Plugging in the numbers, we have 0.8 times 0.10 plus 0.2 times 0.05, which gives 0.09, or a 9% overall flotation cost. So whatever money we raise by selling common stock shares and bonds, 9% of that will be gone. It will be paid to some third party as a fee for helping us go through this process of issuing the new financial securities. Now let's answer the second question. What is the true investment that's needed? Using the formula from one of the earlier slides, we need to take $50 million, which is what the investment requires us to spend upfront, and divide it by 1 minus the weighted average flotation cost, 0.09. This gives $54.95 million. What if instead the proportions of money coming from new equity, new debt were not 80% and 20%, but equal proportions, 50% and 50%? Which part of our calculations for the two questions would be updated? Well, the weights come up in the calculation of the weighted average flotation cost. So where we had 0.8 and 0.2, we will now have 0.5 and 0.5. And that will change our weighted average flotation cost from 0.09 to 0.075. So because we will have less of the more expensive type of financing, the overall flotation cost will drop. And that's exactly what we see from our calculations. And then the new flotation cost will affect the true initial investment for our investment project. We will now divide 50 million by 1 minus 0.075, which will give us 54.05. So it won't cost us as much to start the new project when the financing of the flotation costs for the new financing of this project will become relatively cheaper. Let's look at the following example. A project requires $50 million in initial cost. So we're actually using the same numbers as on the previous slide. 80% will be raised from new equity and 20% will be raised from new bonds. The flotation cost for equity is 10%. The flotation cost for bonds is 5%, just like on the last slide. What else do we know? The investment project is expected to generate $32 million for 2 years. So it's a 2-year project. We also know that the pre-tax cost of debt to the firm is 8% per year, and the cost of equity to the firm is 14% per year. We also know that the company faces a corporate income tax rate of 34%. Is the project worth it? Let's calculate the project's net present value. Let's do it the wrong way and the correct way. The wrong way being ignoring flotation costs completely. Like we don't know anything about them, we don't know what those are. And the right way will be with the flotation costs. The first step to calculating the project's net present value is finding its discount rate. We're going to use the weighted average cost of capital formula for the discount rate. Of course, this assumes, by using the firm's WACC, we are assuming that we are so plugging in the numbers, the weight of equity is 0.8, the cost of equity is 0.14, the weight of debt is 0.2, the pre-tax cost of debt is 0.08, and we then multiply the pre-tax cost of debt by 1 minus 0.34. By the way, in some numerical problems, you're given the tax rate and you're given the after-tax cost of debt. This is a trick. If you are given the after-tax cost of debt, then you're given RD times 1 minus TC. So you don't need to then multiply it again by 1 minus TC, because that's already done in the number you're given for the after-tax cost of debt. So keep that in mind. Read the wording carefully. The weighted average cost of capital gives 0.12256. If we ignore the flotation costs, then we would then use the initial investment of $15 million for this project. If we do not ignore the flotation costs, we would realize that $50 million is not going to be the true cost of this project, because it needs to be kind of adjusted up for the flotation costs, the cost of raising money. The overall flotation cost, when the money comes from 2 sources, new equity and new bonds, will be calculated by taking the weight of equity, 0.8, just like the weight we used in the WACC formula. So notice how we use it 2 times for 2 different things. The weight of equity, 0.8, is then multiplied by the flotation cost of equity, which is given 10%, or 0.1 in decimals. Then we add the weight of debt, 0.2, multiplied by the flotation cost of debt, 5%, or 0.05 in decimals, which gives us 0.09. So 9% of money that we raise will be paid to the third party helping us go through this issuing process, and what's left will be exactly 50 million that we need for the project. So how much extra do we need to raise to make up for the 9% flotation cost? That's calculating the true initial investment. 15 million that we need divided by 1 minus the overall flotation cost. 50 million divided by 1 minus 0.09 gives $54.95 million. So if we ignore the flotation costs, then the net present value would equal minus 50 million plus the first year's cash flow, $32 million, discounted using the WACC as the discount rate. So divided by 1 plus 0.12256. And then we add the second year's cash flow, another $32 million, discounted back by 2 years using the WACC as the discount rate. So divided by 1 plus 0.12256 squared. And that would give us $3.9 million. And we would say that because the number is above zero, the project should be accepted. It's worth it. However, the mistake here is using $50 million for the initial investment. That's too little. The cost is actually higher when the flotation costs are considered. The true year zero cash flow is negative $54.95 million. And that will change the true net present value for our project to negative $1.05 million. Because it's negative, the correct decision regarding this project should be rejecting it. The project is not worth it. So you see how ignoring or not ignoring flotation costs may make a difference between accepting a project and rejecting it. So flotation costs are very important. Too high flotation costs may result in a too high initial investment, which will make the net present value negative. If we ignore flotation costs, we may mistakenly get a positive NPV. So we may mistakenly accept the project, which in fact should be rejected. Let's summarize the entire chapter 14. It's all about the net present value for a new investment project that some company is considering. By definition, the net present value for any project equals negative initial investment in year zero plus cash flow in year one discounted back by 1 year, so divided by 1 plus the discount rate, plus cash flow in year two discounted back by 2 years and divided by 1 plus the discount rate squared, and so on. So we would keep adding discounted future cash flows. First, we looked at what the correct discount rate for a new investment project should be, where it should really be coming from. And we used the weighted average cost of capital formula, which combines the cost of equity, the cost of preferred stock, and the cost of debt. So we were basically saying that whatever it costs the firm every year to pay back to the investors that bought its common stock shares, preferred stock shares, and bonds, that sort of average or weighted average cost is the minimum that the discount rate should equal. Otherwise, the project would not be generating enough money to pay make the expenses pay the expenses to the investors into the firm. We then talked about how the project's discount rate can be used. The project discount rate can equal the firm's WACC, but only when the new project is similar in its risk level to all other projects of the firm. The project discount rate cannot equal the firm's WACC when it has a different amount of risk. In that case, there are 3 solutions. Use divisional cost of capital, use pure play approach, use subjective approach. And we looked at the earlier slides what those 3 are all about. This was the first part of the chapter, the main part. We also talked about how raising money costs money. That's flotation costs. And that has to do not with the discount rate for a new project, but how much we truly need to invest into it. Because flotation costs are additional costs, we need to adjust the initial investment up. So whatever is required, we need to add something extra to it. That allows us to calculate the true initial investment, which is the initial investment that's needed for the project divided by 1 minus the weighted average flotation cost. The weighted average flotation cost combines the flotation cost for raising money from selling common stock shares, from raising money from selling preferred stock shares, and from raising money from selling bonds. So the three flotation costs for these three sources of financing may be different, and that's why we need to find their weighted average. So this is the summary of what chapter 14 was all about. And we first looked at two approaches for computing the cost of equity. One was using the CAPM formula. The other one was using the dividend growth model formula. How do you compute the cost of debt? Cost of debt is the same thing as the pre-tax cost of debt. That's basically solving for the yield to maturity, or IY, in a bond problem. The after-tax cost of debt is that number times 1 minus the tax rate, because interest payments on debt are tax deductible for businesses. And so effectively, the interest rate on loans is kind of overstated. How do you compute the capital structure rates required for the WACC? We need to look at market values of common stocks, preferred stocks, and bonds, rather than book values. So for example, for a bond, the book value is the $1,000 face value, but the market value of a bond is the price that you would pay to buy one bond. What happens if we use the firm's WACC for the discount rate for all projects? We may be incorrectly accepting something that should be rejected, or incorrectly rejecting something that should be accepted. And that's because a firm's WACC can only be appropriate as the discount rate for a new investment project if the new investment project is similar in its risk level to the firm's existing projects. What are the three methods that can be used to compute the appropriate discount rate when the firm's WACC isn't appropriate? We may kind of borrow the rate of return from other companies that produce the same product as what our investment project would be all about. That's the pure play approach. Two, we may just add a couple of percent to our firm's WACC if the new project is riskier. That's the subjective approach, because we are adding a couple of percent subjectively. Why a couple of percent? Why not 3%? Why not only 1%? And the third method is called the divisional cost of capital, when each of firm's division may have its own appropriate weighted average cost of capital, and that should be the correct discount rate that division would need to use rather than the firm's overall weighted average cost of capital when the division is assigned to some new investment project. How should we factor in flotation costs to our net present value analysis? Flotation costs affect the initial cost of our investment. Flotation costs make the initial cost higher. When the initial cost is higher, the net present value becomes smaller.